Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, November 12th, 2014. And in this video, I plan to cover do an overview of the U.S. equity markets. I also plan to do two follow-up videos, either later today or by tomorrow, covering one video dedicated to gold, silver, and the precious metal mining stocks. And the third video will be on the commodities that I'm focusing on right now, such as coal and select agricultural commodities, wheat, corn, soybeans, some of the trade ideas that have been on the site for a little while now. So let's go ahead and start here. We're looking at the Dow Industrials. This is a daily chart, and let's take a look here. What we can see is I've had different targets. Now, all the targets on the charts, the live chart links that I have out there, aren't all lined up. There are various time frames that I had. This is the Dow. These targets I've had up for months now. The first target back here looks like about 1660, 16631 or so. That was hit back in looks like July. Dow went on to make a marginal new high, came down, hit the second target, and fell just shy of that third target zone that I had listed there, and has now gone on to make a new high once again. Um, as most of you know that follow the site, my posts have been very far and few between lately, and that's just reflective of my own trading style. If I'm not actively trading myself and engaged in the markets, then I really don't have a lot to share. I will fully admit this bounce caught me off guard. I was short going into it. We had a very, very timely short entry on uh, the partial rise into that ascending broadening wedge pattern on the SPY 60 minute. That was our entry into the short. So we caught most of the rip down. And although I knew it wouldn't be a straight plunge all the way down, I had considerably lower targets, which I still maintain on most of the other indices, such as the Nasdaq and the S&P 500. But with that being said, this bounce, especially the scope of this bounce, the magnitude of this bounce has completely caught me off guard. And there are times where, I'll beat myself up for missing something or going against my trading rules, but I've looked at the charts, 6 ways till Sunday, and I just do not see where I went wrong, where this bounce came from a technical perspective, at least on my trading style and the way I analyze the charts. Maybe someone else out there caught this and was able to short it on the way down and cover at the bottom. If so, kudos. But I've looked back, and this bounce is about as, for lack of a better word, as unnatural as I've seen in a long, long time. It just came out of nowhere. Wasn't reflected in the charts, and still at this point isn't. So I have step back, and that's one good thing about trading. When you're trading, you don't have to force the market, and there's no reason to. In fact, if the charts aren't going your way, if the trades aren't going your way, by all means, step back. With that being said, I still have a good deal of positions longer term. A lot of the long-term trade ideas, commodities that I mentioned. I still have some gold stocks from a while back. And other long-term positions, but the most of the equity positions that I had, the short trades and all that, a couple of those hit their targets on the way down, their own personal targets, but there are others, quite a few that I've been stopped out on, some that I'm still holding on to, but I am not seeking out at this time, looking to enter any new trades, on the broad markets. And if that changes, I've been on vacation. I took a few days off here, and I'm back now. And I'm going to really dig into the charts here this week. And if I see anything that looks like an objective entry, whether long or short, I will go ahead and post those. Now, with that being said, let's go ahead and move on and get through these charts. I have about maybe a dozen or so we'll try to do these as quickly as possible. Not a whole lot I see here on the Dow, so let's move forward. And usually I don't focus much on the Dow. It's not a very diversified index. All right, this is the NASDAQ composite. This is the daily chart. This chart has been posted often. There's a live link to this chart on the site. And essentially what we've had here, going into all of 2013 and into 2014, we had this channel here, this ascending price channel, a breakdown, and then the price is set up into what I refer to as a sub-channel. This is a parallel channel below there. and I was looking at that for the next sell signal, which we had back here. So there was a sell signal triggered. Prices fell. I had the support level marked here as S1. Once prices fell below there, that was a second sell signal. And as you can see, these were the downside targets that I had, and I continue to maintain. I do believe either by year end, early into next year, we'll see a significant correction. Although right now, I am not adding positions or shorting the market for that. I said a few weeks ago, I made a post labeled not buying it or still not buying it, something to that effect, meaning I wasn't buying into this rally, nor am I at this point. However, that doesn't mean that I'm fighting this rally. I don't have any clear sell signals. I'm looking at the intraday charts. Even my intermediate term trend indicators like that 20-50 day moving average pair, that's flipped back to bullish on both the S&P 500 as well as the NASDAQ and most other indices. So we really don't have any sell signals, and I don't see any very solid bearish patterns setting up, although there are a few things here, and that's why we're doing this video. So what we're looking at here is a back test. We've had which is common. We had a breakdown here of the channel. Prices went on to backtest the channel at that level. Went a little bit higher, had a divergent high, which is marked by the dotted lines here, the dotted lines up top. We had the divergence, and following that divergence, we did have a very healthy correction. Again, not to the scope of what I was looking for, but a nice correction nonetheless. And since that point, we've rallied back quite a bit higher than I thought we would. We've put in a marginal new high so far. But all we're doing right now is back testing that sub channel. So I'm watching here, expecting prices to roll over. But again, my degree of confidence isn't high enough to bet this heavy. After this video, I'll continue to dig into the charts, and I may take some individual short positions if I see some very attractive setups, with good risk-reward pattern ratios. But at this point, as far as shorting the broad market, the momentum is too strong, and I just don't see enough evidence to aggressively short the broad markets. So that's the NASDAQ 100 daily. Oh, nope, that's the NASDAQ Composite daily. Here's a quick look at the NYSE Composite Index. As you can see here, a large rising wedge type pattern, nice clean breakdown, and here's an index where we've yet to make a new high. So although we do have new highs on the S&P 500 and the NASDAQ, and those are what I call the primary indices that that I track and most people follow, we don't yet have it on all the indices, including the small caps and mid caps. One of the easiest ways for me to sum this up is the near term, even the intermediate term picture is somewhat obscure in my opinion. I can make a glass half full or a glass half empty case. And when I can do that, when I can't make a clear one-sided argument to either be long or short the broad markets, that's when I step back. But as we go forward here, I'll look at some of the longer term charts, some of the weekly charts, and I continue to maintain a longer term, a bearish outlook for the market. Again, that's longer term. The current trend is up, is bullish, and we don't have any sell signals yet, but that's something I'm looking out for. So that's again the NYSE Composite, an index that has broken down from a well-defined uptrend line and bearish pattern complete with negative divergences at the highs and has yet to make a new high. So overall, I view this as a counter trend bounce and a new downtrend in the NYSE. Okay, here's the S&P 500. This is a daily chart. I probably should zoom in, but you can do that as you're watching this video. If you'll notice up here, let's see if I can annotate this with a screen draw function here, if I can get the right pen or line. What I have up top is you can see these lines. I have an ascending broadening wedge or broadening top pattern, similar to the one that we shorted back here on the SPY 60 minute, although this is larger. A fully mature pattern, 1, 2, this is the third tag up top. We have 1, 2, 3 touches on the bottom. So this is a potential bearish topping pattern. And now, of course, we'd need to see prices turn down here soon and not take out the symmetry of this pattern. In other words, we have this uppermost trend line, and let's see where that goes. Let me clear those out. Okay, and if we also, I took those lines away. Here's the uptrend line. This is the shorter term. Again, we're looking at a daily chart. So here's an uptrend line that I have going back from October 2011. This was the uptrend line that we broke below. And I've also put the Fibonacci retracements from that low up to the recent high, at least at the point we turned down, not the high that we've just made. I was looking for at least a 38% retracement of that move. We have not had a solid, healthy correction in this market in years. This market has just continued to grind higher. It's been much more of a investing, buy and hold market than a trader's market. When you're trading, actively trading, short-term swing trading, even a few weeks, couple months holding periods, you want volatility. You want the VIX up. If you take a look at the VIX, it's reflective of this slow grind that we've had over the last couple of years. Yes, we've had these little minor corrections along the way that were snapped back up, but we haven't had a big, healthy flush out in a long, long time. And at this point, I'm still looking for one. And again, a lot of that has to do with the longer term charts. Near term, still a little uncertain. It is worth noting down here, I haven't updated this chart. I can draw that real quick. We do have the MACD making, I'm drawing the RSI here as making a lower high underneath this broadening wedge pattern. So there's negative divergence there, although this crazy move up, and I don't recall a move in the MACD this sharp. We were down around -30 and we shot all the way up here to 25 or so, almost in a straight line. And of course, that's reflective of this unidirectional move here off the lows. So very, very impulsive buying, and again, came out of pretty much from nowhere, in my opinion, and it feels very unnatural. And let's just wait and see what happens here. I'm, like I said, standing on the sidelines right now, and if I find any interesting setups, I will post those. Let's go ahead and move on. Okay, now we're on the S&P 500 weekly chart. This is a weekly chart covering the entire bull market back from the March of 2009 lows. I've been harping on this a lot. This is the primary bull market uptrend line. It defines this, nearly 6-year-old bull market. I put a lot of emphasis into this trend line break, and we had that solid, impulsive breakdown and weekly close below the trend line, which, as I mentioned, would be an early indication of a possible longer-term sell signal. Prices have, in this sharp rally over the last couple weeks here, have managed to get back above. Not by a whole lot, but they are slightly above that trend line. That is, again, one reason the near-term picture is obscure, even the long-term picture at this point. However, it's worth noting, even with that marginal new high, we're not too far above the trend line. These things aren't always an exact science. You'll have these little, typically they're intraday pierces, and then we have had a weekly close back above it, and that's what's put me on pause and led me to step back and disengage from the markets for a bit. But it's worth noting that we continue to have the divergences, these negative divergences persist. And as I mentioned, these are not very common. You look back, this was the bull market back in 2007. I'm over here on the left side of the chart. We had the negative divergence leading up to those highs. Oops, I have to draw that out here. Oh, the line's already there. We had the negative divergence leading up to the highs there. Negative divergence down here on the MACD. We had a divergent high back here about halfway through this bull market. Actually, two divergent highs, one at this point right here and one at this point right here. Both led to healthy corrections, and we've had this long-standing, nearly 2-year divergence building here. And all we had was this little tiny correction. That's what just doesn't fit. It doesn't sit well with me. And the fact that we also shattered that uptrend line, my expectation is for continued downside. And I do believe that at some point within the next few months here, we will take out those recent lows and go on and make it, at least a healthy retracement. More than likely, that's going to take us down and probably exceed a 20% correction, which, by definition would be a new bear market. So we'll see. At this point, the ultimate downside targets, I maintain the targets that I have right now in the S&P and the NASDAQ composite. Those are my near-term targets, and we'll just have to go from there if we get any more selling. And if the market continues to go up, sooner or later we'll see some bullish developments, and we'll see these divergences negated. In other words, we'll see the MACD and the PPO go on to make higher highs, RSI, things like that. But right now, I'm still just looking at the weekly charts alone and some other developments, which I'll touch on here in a minute, leaning towards additional downside and more than likely taking out the recent lows within the next few months here. Here's a quick look at the Dow Jones Composite Average. If I'm not mistaken, this is a combination of the Dow Jones Industrials, the Dow Jones Transports, and the Dow Jones Utilities. So a much more well-rounded index. And you can see the green lines here and here show the same type of a megaphone, i.e. broadening wedge, broadening top pattern. So something to watch there. Prices are at the top. In fact, this uppermost trend line, I have the green line stops right here, but if you look back here, I had this blue trend line for a long time, marking this negative divergence up here. So there's an uppermost trend line that so far prices are respecting. Looks like if you really zoom in here, you can see us rolling over, but still some work to be done. We'll need to see prices from this point continue to move lower to even say that may be a valid pattern. And of course, we'll need to see a downside break ultimately to strengthen the longer-term bearish case. I'm really not focusing on sectors in this video, just the broad averages, but I did want to look at I had the transportation index in here, and you look at this long-term, this nearly 2-year ascending price channel, and you see the breakdown from that channel, very impulsive breakdown. And again, this reversal just came out of nowhere. We had a divergent high at that point. From my experience, this pattern breakdown, the impulsiveness, the divergence leading up to it, projected a lot lower than what we saw there. So it seems to me like this reversal just about came out of nowhere. I would have at the very most expected, back test this channel and then a reversal, a continuation lower. But so far we've moved back up. Now it's interesting to note we're now right back to the top of that channel. So here's a long-term, trend line that may need to be respected. So we'll keep an eye on that as well. I already touched on the NASDAQ composite. This is the NDX 100, which usually comes close to mirroring the NASDAQ composite, of course. This is just the 100 largest components in the NASDAQ. Same story. We have that uptrend channel, ascending price channel, breakdown, the sub channel there. Prices broke down very impulsively and have come up back to back test that channel on a marginal new high. If you look down at the bottom of the chart here, we still have significant negative divergence in place on this new high that the NDX is making. Not so much on the MACD. We've made a slightly newer high there, so that's taken out any negative divergence there. We hit the first target way back when, after we broke this first uptrend channel earlier this year. However, these are my additional price targets, and I do believe this blue uptrend line, this longer-term uptrend line, I do think this target is likely to be hit in the upcoming months. Especially what I'd like to see is an impulsive reversal off this back test. Prices start to move lower, and this would be my next downside target. Excuse me. This is a chart I've put up quite a bit over the last few months. This is the OEX, which is the S&P 100 index, so 100 largest components in the S&P. And, this measures, these lines here show you the previous bull and bear markets. The green lines are the bull markets showing the bull market uptrends. The dotted blue horizontal lines mark the exact tops. Again, reference this chart. It's on the site. Type in OEX, I would imagine, in the search field, and you'll find it. The bull market back in from 95 to 2000, that was 5 years, 3 months, 16 days. The next bull market was 5 years, 2 months, and 18 days. And up through the recent highs, September 19th. Now, keep in mind, we've made a marginal new high, but last time I updated this chart was on September 19th, and it had been 5.5 years. So the point here is bull markets on average, and especially on the last, what is this, 2-decade-old chart, they last about 5.5 years, and that's where we are into this one. Another common characteristic is you will typically see divergence at the highs. This is the RSI up here. The PPO down below. You can see divergence leading up to each market top, and each bull market has been defined by a relatively well-defined uptrend line. And again, we broke through that bull market uptrend line recently and have come back to regain that just by a slight margin. Again, unnatural price behavior, and another reason I'm taking a step back and would like to see prices sooner than later come back below that uptrend line to really keep that longer-term bearish case intact. But with that being said, even if we don't, we still have the important things here are the divergence, the timing on this whole thing. And remember, it always looks rosy right at a market top. Everything looks great. The markets are strong. Sentiment is high. So just keep that in mind that, when we do finally, when the bull market ends, you won't know it till well after the fact, and especially if you pick up the paper and read the headlines and listen to CNBC, they're going to start talking about a bear market well after we've exceeded or right up upon that 20% drop. That's when you're probably going to start to hear that talk that we're in a new bear market. This is the OEX, also a weekly chart, but zooming in a little bit more to this bull market. Here's the 2009 lows. This chart I posted as well, I believe. These are all instances of divergence down here on the PPO. These are the 1, 2, 3, 4 times we've had major negative divergence. And up here on the RSI, 1, 2, 3. Now this current, what you look at, this is an extension. So we have multi-year, 2-year negative divergence building with the RSI making lower lows, the PPO, which is similar to the MACD, making lower lows. And even on this push, this push to recent new highs here, we have even an increased, slope, negative slope in the on these trend lines here. In other words, this is another divergent high. Once again, this new high. And, once again, we're looking at 5 years here in this bull market, over 5 years. And in every instance, if you look at, I don't know if you can make out, I have some shaded gray arrows here. You look at the scope and intensity of these previous corrections, which were preceded by much smaller divergences, shorter lasting, and yet we had much steeper corrections. Here was a modest correction, but I still believe that was even more than what we just saw. So this, again, just doesn't fit. This correction, I don't believe, is the end of it. That's too minor. These divergences persist. And yes, can the charts change? Absolutely. Maybe we go on and rock it up and have a blow off top. That's always a possibility, and that could last into the end of the year or even into the beginning of 2015. And if that's the case, you'll probably see these divergences taken out. But again, we're looking at a weekly time frame, and we have not yet taken out the divergences. In fact, they've only continued to build, and they're even more pronounced now. The daily time frame, that's a little bit different. This recent run-up, a lot of the negative divergences have been taken out, or what I say negated, but not so on the weekly time frame, and that's what keeps my overall longer-term view on the U.S. equity markets is bearish for now. Probably the most bullish of all indices out there is the NDX, the NASDAQ 100. This is a weekly chart. I've mentioned this uptrend line before. This is the one index that I follow, the one U.S. index, major broad diversified index, including small caps, mid cap, large caps, that has not yet broken down its bull market, never did give way. We had an intra-week break, and as I always emphasize, if you're trading a weekly chart, looking at a weekly time frame, you want to see a weekly close. Well, the NDX broke down intra-week but managed to hammer back above right up on top of that trend line. So this is one index yet to break down with a confirmed weekly breakdown. But again, here is a chart. Gosh, what does this go back to? 2004. All the divergent tops are marked up here. Again, it's a chart that's been posted. And if you follow each and every one of those divergent highs, you see significant corrections. And as I pointed out, prices have been hugging this trend line. We're much closer now. So if we have a correction anywhere close to what the average correction has been following these other divergent tops, that's going to put us well below this bull market uptrend line. So that's yet to happen. But as of now, like every other index out there that I follow, we have negative divergence, solid, clear. We see the MACD or the PPO making a lower high, RSI making lower highs against prices making higher highs, and I'm talking currently where we're at right now. So that divergence is in place, and that has not changed my longer-term view. Here's the mid-cap index. This is the S&P 400 mid-cap index. Same story. Again, something I posted recently, so I won't spend too much time. You see these divergent highs, 56% drop in the market, 28% drop, and I put a question mark here. We have the third divergent high over this same span, and yet what did we have? I forget what the correction was, but it wasn't even anything close to these previous bear markets. So is this to be continued? Also note that if we zoom in here on the mid caps, we had a nice breakdown, a back test of the trend line, and then an impulsive move lower, and we are still below the highs that were put in all the way back in, earlier this year. So there's an index that's looking bearish, and so far this only looks like a counter trend bounce and a possible new bear market here in the mid cap. And then finally, here's the Russell 2000 small cap index. This is a weekly chart. Here's the 2009 lows, March of 2009. This blue uptrend line is what I refer to as a primary bull market uptrend line. We had a nice, impulsive, solid breakdown below that. And even as I pointed out a couple weeks ago, we started backtesting. And if you look closely here, prices continue to remain below this uptrend line. They are crawling, backtesting from below. And again, something to watch. If we regain that trend line, especially going to break out to new highs, again, that does chip away at the bearish case, but it doesn't completely eliminate it because if you look here, we have plenty of room to go. We still have a strong divergent high, negative divergence on the RSI, very strong divergence on the MACD. So even if the Russell were to rip up here over the next week or two and eke out a marginal new high, it would almost certainly be a very powerful divergent high. Something else to note, I know these are probably very hard to pick up on the YouTube video unless you're watching in high definition. These lines here are Fibonacci fan lines. And what I did is set this was the first fib fan line that defined this uptrend. We had a point here, a reaction here, and here. We had this next one here that kind of capped the upside move. And this blue uptrend line that I have, the primary bull market uptrend line, right underneath that lines up perfectly with one of the other fib fan lines. And, we've now broken below that. So you tend to see these reactions. If you look here, we broke below that first fib fan line, came down, touched the other one to the penny, skated along it for a few weeks, had a very impulsive quick breakdown to tag the next fib fan line, which again is right underneath this blue uptrend line. Came back up under there, stayed above it, broke below, and then back tested from below. Came down, hit the other one. So if you really take a look, freeze this chart, pause it, or put it up on your own chart, you'll see it's pretty impressive. And I've seen this before with other stocks, how well they act at times. You have to find the right index or the right stock, and it's just almost uncanny how well they act. These fib fan lines act as support and resistance. So again, the important thing is that we broke this middle fib fan line right here, and are now currently backtesting that as well as the primary bull market uptrend line. So my expectation would be, hard to say how long we'll backtest it, but if we were to turn down low, the next logical target would be this next lowermost Fibonacci fan line there. Okay, last index chart, and then there's one more thing that I'd like to cover, which I believe is important. This is the Wilshire 5000, a very well diversified index. We're looking at a 20-year chart. This chart's just over 20 years. And it just shows, again, similar to the OEX chart that I showed a minute ago, shows the three major bull markets, and of course these are the bear markets. Once these bull market uptrend lines, these patterns, which are all wedge type patterns, very large wedge type patterns, and that's indicative of a bull market or any move. Towards the top, the gains, the rips become smaller and smaller as momentum wanes, and then you have a breakdown. So again, something to watch. Again, the fact that they all have this divergence in common, negative divergence leading up to the highs on both the RSI and the PPO, same story across the board, and that is what really keeps me in the longer term bearish case, especially the fact we're right here at the apex of this wedge. I mean, is it possible to see a blow off top? Well, first of all, anything is possible. These can just go on forever. We can pull down, go sideways, move up, but more than likely, these, we're in the latter stages of this bull market now. Okay, one more thing to focus on, then we'll wrap this up. Okay, this last chart is something that you don't hear talked about often. I think this is one of the most useful tools. You don't have a lot of signals off of this chart, but I do think it works as a canary in the coal mine. Can warn you when something is amiss in the financial markets. And what we're looking at here is the BOA Merrill Lynch U.S. high yield option adjusted spread. These are junk bond credit spreads. In other words, the insurance you pay for default on junk bonds. And this is, the blue line is here's the scale up here, the BOA Merrill Lynch high yield. And the S&P 500 is the red line below. So as you can see from this chart, we're looking at a 10-year period. There is an almost nearly perfect inverse correlation, meaning when the stock market goes up, junk bond yield, the option spreads go down, credit spreads go down, and vice versa. Here's the shaded area. Here's a recession. This is a financial crisis. So the market's actually peaked. As always, the markets forecast, they say 6 to 9 months out what's going to happen in the economy. And so when the market peaked back in October of 2007, the recession officially started after that. But you can also see here what I'm focusing on. There are 2 points in history, at least on this 10-year chart. And I have pointed this out on the site. This was pointed out, in fact, just a couple months ago, right before we had this most recent sharp correction in the markets. I had pointed out a very unusual, rare divergence between these two here. And the last time we saw that, let's take a look, let's zoom in here, was back just before the financial meltdown, before the last bear market. So I'm trying to zoom in here, if you bear with me. And what we're looking at here, back in, looks like early June, about June, let's see if I have it here in my notes. It was actually June 5th, or we'll call it early June, in 2007, that's when the credit yield spreads bottomed. In other words, from that point, the blue line, credit yield spreads started moving up. Yet, something odd was happening. The market was going up as well. See, this is at the end of a bull market. Giddiness, complacency is at an all-time high. And, that's at the point where people think stocks will go up forever. Yet, there was something wrong here with stocks going up and credit yields going up. So we had this first, what I call a shot across the bow. And I remember that I was trading back in 2007. And in the summer of 2007, we had a pretty healthy correction. And then what did the markets do? They went on to rally to make a marginal new high, and they peaked out around October 10th, early October 2007. So what you notice here is during that rally, we did have an abatement. The credit spreads did fall back a little bit here, but they didn't go anywhere near their previous lows. Now, once again, the market went on to make a new high. Logically, you might think, well, credit yields, should then credit spreads should drop down and make a new low. That wasn't the case. So we did have a minor abatement, a little drop in the credit spreads while the market went on to make a new high, but they were still well above where they were earlier in the year, in early June. And, the rest is history. The markets then started falling. This was the, the financial meltdown, the bear market, the collapse, after the highs. And as you can see, credit spreads went up. And you can take a look at this chart yourself. This is on the Fed site. It's the Economic Research Federal Reserve Bank of St. Louis. Just Google Fred graph, something like that should get you there. And as I pointed out recently, this chart, if you look at these peaks and troughs in the market and in credit spreads, they're almost perfectly correlated and timed. In other words, when the market corrects, the credit yield spreads spike, and then the corrections over the market start going up, and credit spreads, immediately drop until recently. And this is something I pointed out a few months ago. We had very similar to back in 2007. We had credit yields, the spreads drop and bottom out. It looks like, let's see, about June, back in June 23rd. Yep. And what has the market done since then? Well, the market's gone on to make new highs. However, credit spreads have now increased sharply. And just like back then, just like in 2007, I pointed out that we had that shot across the bow in the summer of 2007, and then the markets went on to push to a marginal new high. Well, look what's happened here. We've had this huge backup in credit spreads. And yes, did they abate somewhat? Absolutely, during this latest rip, but they are nowhere near where they were back in June. Back at that time, remember, that was 4 months. It took 4 months from that where credit spreads bottomed in June of 2007 till the market reached a high. It has now been 4.5 months, and the pattern is almost identical. Now, of course, two things will happen. Either the markets will continue to go up, and this was just a little worry that's going to pass, and we'll see the credit spreads drop down and probably go on to make new lows. But again, if I implore you to take a look at this chart, play around with it, study this chart. It's something I posted on the site a couple times. This is my canary in the coal mine, at least a caution flag. Again, I don't have any short-term sell signals. My trend indicators have flipped back to bullish, but this is telling me be very careful on the long side. If you want to take some long side trades, if I take any, they'll probably be quick breakouts. They won't be my typical swing trades that last from 3 to 4 weeks all the way out to 3 to 4 months. Not going on the long side right now until I see this discrepancy here, or this caution sign go away. So I think that was the last chart I wanted to cover. Let's see here. Although, you know what, I'll hit on these two real quick before I wrap up. This is again, another chart that's been posted many times over the last year or so. This is the percent of stocks in the NASDAQ trading above their 200-day moving average. That's what we're looking at up top, the orange line. I'm sorry. No, the orange is a NASDAQ composite index. I'm sorry. So here's the NASDAQ. This is what it's done. We're looking at going back all the way to 2005. And the green line here, as it says, NASDAQ percent of stocks trading above their 200-day moving average. What we look for here are divergences. When the market is making new highs, you should have quite a few more stocks trading above their 200-day moving average. Not when you see this divergence, market going on to make a new high, yet the number of stocks trading above their 200-day moving average is falling. That is showing you a deterioration of market breadth, the underlying market breadth. And the red arrows show the correction that have followed these divergences. So if you look on this chart, you see these dotted white lines, these vertical lines. That marks the market top. And you can clearly see the divergence leading up to that with the stock market or the NASDAQ making newer highs and the corrections that have followed. So we had one here. And this is the last time I pointed this out. We did get this correction here. However, what's happened since then? Well, the NASDAQ's gone on to go up quite a bit higher. This divergence continues, but look at this huge drop-off in the percent of stocks making trading above their 200-day moving average. So this shows that this latest advance is anything but healthy. And we can look at the same thing on the S&P 500. Let's see, percent of stocks above their 200-day moving average. That should be this chart here. Same story. Take a look at it. This chart has been posted. You can find that on the site. If you have any questions, contact me, and I'll try to send you out a copy or a link to this chart. But again, yes, we had a correction following this most recent divergent high. Well, the most recent divergent high is taking place as I speak, and yes, it is still a very pronounced divergent high. We had a divergent high just recently during that correction, but again, it just doesn't fit. You know, we had this small one back here, but most of these corrections following such divergent highs are considerably more steep. So again, that helps speak to the longer term bearish case. Okay, folks, this has been Randy Finney with Right Side of the Chart, and I hope to have the video out on the gold and other video on the commodity stocks out shortly. Thank you very much.